To do well in accounting, you must know the accounting equation. Without fully understanding this, then everything else falls, like a house that's made out of sticks and not bricks. A strong foundation of knowledge is key, so pay attention. Let's first understand what each component is about. An asset is defined as a present economic resource controlled by the entity as a result of a past event that has the potential to produce economic benefits. So let's break this definition down into simpler terms and get a full picture of what this means. A present economic resource is something that you have control over. A result of a past event, for example, company buys land. The purchase of land is a past event, and the land becomes an asset on the balance sheet. Potential to produce economic benefits is when a resource is expected to generate income, lowering costs, or being exchanged for other goods or services. You got to note that assets, aka the resource, may be tangible, which means it has physical characteristics such as land, buildings, and equipment, or intangible, assets without physical existence, such as patent rights or legal claims. So let's take a specific example and apply the definition. So let's use cash. Cash is considered as an asset because 1. It has value. Cash can be used to buy things, pay bills, or invest in opportunities, which makes it valuable for future use. 2. You control it. If you have cash, you own it and can decide how to spend or save it. 3. You got it from something in the past, whether it's from selling something, getting paid, or borrowing money. Cash comes from actions or transactions you've done before. Because cash is valuable, easily controlled, and comes from the past actions, it fits the definition of an asset, which is anything that can help bring more value in the future. Next is a liability. So a liability is defined as a present obligation of an entity arising from past events, requiring the transfer of economic resources. In other words, these are amounts that are owed to outside parties. So if I put this definition in simple terms, it is where a business or person owes because of past actions. It means they have to pay money or give something valuable to someone else in the future. A few examples could include things such as accounts payable. This is when money is owed to suppliers for goods or services received but not yet paid. You got accrued expenses, expenses incurred but not yet paid, such as wages or utilities. And you also got things like unearned revenue, which is money received for goods or services not yet provided, like a prepaid subscription. The final component of the accounting equation is equity. This is the owner's claim to residual interest in the assets of the entity after removing all of its liabilities. Think of it this way. If a business sold all of its assets and paid off all of its debts, the remaining money would be the equity, which is the value that belongs to the owners. Equity is often referred to owner's equity in small businesses or shareholders' equity in companies with shareholders. In simple terms, equity is what the business owes to its owners or shareholders after covering all other debts. So back to the accounting equation and seeing the bigger picture. The basic accounting model introduced earlier, which is assets minus liabilities equals equity, indicates that the total assets of the entity equals the total claims against those assets by creditors and owners. Creditors' claims take legal priority over owners' claims, with owners being the ultimate risk takers in the entity. So, if the assets are sold, creditors must be paid before the claims of the owners are recognized. Thus, equity is a residual, aka leftover, claim on the assets, and the basic accounting model is expressed this idea clearly.